Hello and welcome to this urgent market update video brought to you by the Live Trade Room. Now, today is Wednesday, the 8th of February, 2023. And the title of this particular video is, as you can see up on screen, is "The Fed are flaunting their fabulous failures in Feb." So it's a bit of a tongue twister for you. However, we've intentionally paused the production of this video just to see how things were going to unfold. We had a very important news event last week. We had the FOMC, and it was a very important event, and I'll touch upon it again in a little bit more detail. But we've had a series of other economic indicators as well in there. For example, the jobs numbers, and we'll see how all of this fits together and what signals the Fed was sending to these markets and how they responded accordingly. So it should be a little bit of a breakdown in terms of why we think potentially the Fed have made a bit of an error, bit of a mistake, and what the likely opportunities are as a result of that. So let's get straight into it then. We'll start, of course, with our risk warning. Take a brief moment to familiarize yourself with our risk warning currently up on screen. And let's get straight into it then. So we think the Fed have made a pretty significant, let's say they've made a significant judgment call based on the the information that they have at hand. Now, these are the same central bankers that decided a year ago that inflation was transitory, and that proved to be not just incorrect, but just an horrendous policy line to take in the face of, really significant inflation. And yet they did that. Now we find ourselves in a similar sort of situation now. So let me take you back to the important events of last week. And we're going back to last Wednesday, the 1st of February. So we've had a bit of a strong bounce at the beginning of the year. We were in two minds in terms of, in fact, let me bring up the charts first so you can see when we were looking to trade these markets, as you can see up on screen, we were in this little slightly longer term little sideways pattern and a significant range. And we always said if prices could get above basically the 4,100, we'd be looking for buying opportunities. And if they get below the 3,800, 3,700, we'd be looking for significant selling opportunities. So the first opportunity that arrived as a result of the FOMC on last Thursday, the 1st of February. And that corresponds with this move here. And that gave us certain signals in these markets. So just take note of the fact that this market is showing some real positive gains. So there's kind of a risk on market condition to these markets. So with that in mind, what the news event of last week was we had ADP numbers which came in and disappointed really quite significantly. We had a disappointing manufacturing number come in below expectation. We then had a slightly unusual and mildly uncomfortable job openings number where we saw nearly 1 million jobs more available to those that are unemployed in the US. And this means there's still, close to two jobs available for every unemployed person. So a really strong jobs market. And then the Fed had a decision to make, and it was pretty much consensus that we see a 25 basis point rate hike. The problem we've got is if the Fed were really serious about, bringing down inflation, which is currently at 6.5, we're still 3.25 times where the Fed anticipated we'd be, between 2 and 3% inflation, and we're seeing 6.5. So we're still at elevated levels as far as inflation. And it seems as if the Fed last Wednesday basically started popping the champagne corks and, kind of claiming we're in this disinflationary environment. And it's like as if, we're still going to hike, but, we've kind of defeated inflation. That's the way it transpired. And that was certainly the theme that the markets took from that, is that it was quite a dovish FOMC meeting and press conference. And certainly the markets perceived Jerome Powell, the Fed chair, to be actually more of a dove than a hawk. Even though he's talking about rate hikes, he's actually, with his actions, he's reducing down the rate hikes. And we've jumped from, just to show you this chart on screen now, we've jumped from 75 basis points to the previous meeting, we jumped 50 basis points. And in December, we jumped 50. And in this one, we've jumped 25. So there's a clearly defined slowing as we get up to this 5% mark. So what should have been probably a hawkish FOMC actually became relatively dovish. And I'm going to break down the differences between being a hawk and a dove in just a second. But there's more information to come. We held off because we wanted to see what, in terms of making this video, we could have said, right, the Fed came out and it was broadly quite dovish. We are looking for prices to kick on to the upside. But we, of course, on Thursday, we then had the BOE, and we had the official bank rate increased by 50 basis points, with more to come. And we also had the same situation from the ECB, 50 basis point rate hike with more to come. So very hawkish outside of the US. And we had this strange dynamic, which was kind of a partially hawkish, but probably more dovish response from the FOMC and from Jerome Powell. And that fed in nicely into the unemployment numbers, because we were thinking if we came in below 200,000, there's arguments to suggest, okay, we do have a bit of a green light to the upside. And we saw a massive 517,000 jobs added to the US economy. That's huge. That's a multiple. It's 2.5 times what we were even expecting. And it just shows you how all those in Wall Street get all these figures and forecasts, how wrong they can be. Now, it is, and it has been a challenge, employment numbers in the US since COVID, and they're still ironing themselves out. But we've got an unemployment rate now of not an increase of 10 basis points, but a decrease of 10 basis points. So that's a 20 basis point swing. So the unemployment situation in the US is remarkably strong, and positive services, but negative manufacturing numbers. So we've got, I think it's fair to say, we've got a pretty significant mixed bag. And we were very interested to see how this would play out going into last night's Fed Chair Jerome Powell. Would he actually reverse his dovish outlook from last Wednesday? And would he then become a little bit more hawkish? We were anticipating that would probably be the case. And we saw, as a result of this event, we saw yet more buying creeping into this market. So we've heard from the Fed on 2 occasions, and we've seen some sizable move to the upside on 1 occasion, followed by yesterday, again, further upside. So this is why our bias really at this point, now that we've broken out of this range, this strong range in here, and it's interesting to see yesterday's low, it coincided with the 4088 level, which is a level that we were talking about in a lot of detail during our live broadcasts. But we've also broken out of this descending line on screen now, as you can see. So we've clearly broken out of this range. So now we're in and this is really adding a bit of upward momentum as well to these markets. We can't take that away. So the reason why we think the Fed have sort of made a bit of a policy error is because they're assuming they're going to see inflation come down. So now we're actually in a situation where we're going to be remarkably data dependent. So to sort of take a bit more of a step back from these markets, we've been in a strong bear market since the beginning of last year, 2022. And at the beginning of this year, we started to make higher highs, and we're in a pretty significant little mini uptrend in this market. Now, if the Fed are correct with their assumptions that inflation's over, then we will, we might see a bit of a corrective move, but ultimately we'll see further continuation to the upside, and it is quite dovish, and we can get a lot of support from these markets. The opposite is also true. If we find out that inflation, let's say oil prices tick from $80 currently, or close to $80 up to 90, 100, 110, all of a sudden we're in a very different inflationary environment, and inflation will start ticking higher. Under those circumstances, we'll see some very significant selling So the decision becomes whether these markets are going to interpret a bullish and hawkish mentality, or whether they will maintain their kind of dovish approach to these markets. And being a dove means that we're likely to slow down the rate of rate hikes and potentially pivot and start bringing rates down. That versus being a hawk, which would signify that rates actually need to stay higher for longer and we're going to get rate hikes. So each of these little policy features, and the Fed are very, very aware of the signals they send to these markets. We have a series of different outcomes, so we can look for these opportunities in with significant focus. So I've already suggested during those two news events that the markets have perceived what the Fed was saying as they were ignoring what was being said, and they were focusing on the decisions that the Fed actually made. So they actually created a bit of a dovish little sentiment behind these markets, which can be interpreted, and you can see it in the price action as being actually a bullish response. So, and this is really the point of this sort of matrix in here, is that as a result of last Wednesday's FOMC and yesterday's interview, really, with I forget the name of the interviewer now off the top of my head, but it was televised interview. The markets reacted accordingly. So we saw some risk on market conditions. We see an appetite for risk as a result of sort of further continuation of the Fed talking out of both sides of their mouths. They're saying, yes, we're going to remain hawks, but actually the actions we're taking are still quite dovish, and there's a lot of talk about deflation. So that just implies that there is the threat of inflation is diminishing, and we'll see in time whether that's going to be the case or not. And we're anticipating that the Fed might have made a bit of a policy error here. Now that's likely to be good for us because it's likely to give us some heads up on some very significant opportunities. So we can look for risk on market conditions if you know the markets react in a very dovish approach to Fed sentiment. We can look for risk on. We can also look for the US indices to push higher, which is what we're currently in the middle of looking to do, and we're waiting for the next opportunity to arrive. We can then look for a weaker dollar, and that's going to be a tricky one. I mean, the indices higher and the US dollar lower can be a set of tricky trades to sort of navigate. And it is because of this kind of trade-off between, you know, what the Fed are going to do and whether there's going to be a dovish sentiment or a hawkish sentiment. But sticking with the rate pivot, the dovish momentum, we can look for higher indices, US indices. We can look for a lower dollar. We can also look for US bond yields lower as well, and commodities to push higher as a result of a weaker dollar. So that can be compared and contrasted very nicely. And we're talking about narratives here. If the markets adopt more of a hawkish narrative, which is rates higher for longer, then we will probably see that risk come out of this market. We'll see the US indices rolling over to the downside, and we're probably likely to see a stronger dollar. Now, the correlation between the indices and the dollar has been inverted really since last Wednesday's FOMC. So we really want to see those correlations play themselves out. But certainly look for a higher dollar, and we'll be looking very carefully at US bond yields and see if they start pushing higher as well, which is a likely outcome. And as a result of the more expensive dollar, commodities, we'd expect to see a little bit of rollover to the downside. So these are the options that are available to us as traders. This is what we'll be actively, you know, looking at day to day to see where the opportunities may lie and see how we can trade them. So hopefully that makes sense. This is why we're certainly of the opinion that the Fed are potentially flaunting their fabulous failures. You know, they had an opportunity to close the door to actually address the inflation issue, which they said themselves is their most important achievement. And we don't think they've lived up to being able to achieve that yet again. The whole transitory discussion this time last year took a similar view. We couldn't understand why they were still referring to this inflation, this structural inflation, as transitory. It was clear to see that it was more structural than that, but they couldn't see that coming down the line. For some reason, we have no idea. And we think they're making that little error once more. So you may have questions about anything covered in this particular broadcast. So if that's the case, do feel free to email us at support@thelivetraderoom.com. Myself, one of my colleagues, will get back to you as soon as we possibly can. But that just about concludes this particular video. So thank you very much for joining us. Do stay tuned for our next video. We do, just to let you know, we do broadcast our trade plan sessions live at 7:30 a.m. for our early morning trade plan. So it's important, especially in these quite choppy market conditions, that you do have a plan that you do want to try and execute. We do that as a process, really, in terms of being able to identify those high probability trades at 7:30 every morning. We also trade the European Open from 8 a.m. for the best part of an hour or two. And we're back again broadcasting live from 12:45 for the US Cash Open. So we get an influx of capital around those times, and we look to see if we can make some good trading decisions, identifying high probability trades at those times. For more information, just go to thelivetraderoom.com and you're able to join us now for as little as $49 per calendar month via our website. And there is a chat function there as well. So if you've got any, if you've got any questions whatsoever about, how we help traders trade these markets consistently, then you can chat with us through our website. So on that note, guys, thank you so much for joining us, and we look forward to seeing you next time on our next video. So for everyone here, take care and bye for now.